Very good morning to all of you students. Today we will be continuing with the topic of interest rate risk management. So students, we will start our discussion from swaps today, which is one form of the technique to do the interest rate risk management. So in our previous session, we have covered till interest rate guarantees or interest rate options. So let's start our discussion on swaps. This we call as interest rate swaps. Good morning, Gurram, Shailesh, Viraj, Prashant, Satish. Good morning, everyone. So, students, hear me out carefully for interest rate swaps because first we are building our understanding on the swaps, then we will go to the questions. So, let's say there is a company A and there is a company B. Company A is a very well established company. Okay. It has been there in the business for long and they have a good credit rating. They are earning good amount of cash flows. They are generating good amount of revenues. They are well established companies and hence they prefer the interest rate to be on the floating percentage wise. Okay. So, I mean, if you see the risk profiles of each and every company, some companies prefer the interest rate elements to be on the fixed basis. Some companies prefer on a floating basis. By floating basis, I mean whatever they borrow, they will end up paying the interest rates on a floating amount basis. Just a second. Just a second. Give me 1 minute, students. Just a second, student. There is some update. Good morning, Shruti, Mansha, Kirti. Good morning, everyone. So, okay, till the time it is loading, what I was saying is that let's say there were two companies, company A and company B. Since company A is a very well established company and the preference for that company is to borrow on a floating basis because they are okay to take the risks and all. Similarly, company B is not a very well established company, is a very recent company. Okay. So company B is a very recent company. They are very less side. Hence, they don't want to take the borrowing on a floating rate basis. They want to take it on a fixed rate basis, students. Yes. Okay. So they want to take the borrowing on a fixed rate basis and hence they want to fix their fluctuations on account of the interest rates. So company A is actually a well-established company and their preference is floating percentage. Similarly, company B is a very new company and hence they prefer fixed percentage. Okay, they prefer a fixed percentage, students. Both of them approach to their respective banks. Let's say company A approaches to bank A and company B approaches to bank B. Okay, they have their own set of bankers. They are approaching them. So bank A says that if you want to borrow a fixed coupon loan from me, I will be giving you a loan at the rate of 7%. And in case you want to borrow, basis the floating rate. So I will exactly give you the MIBOR rate. Whatever is appearing in MIBOR, I will give you that. Because you have a good credit rating, I will not add any spread to the MIBOR that is getting operated. And in case you want to have it fixed, I will give you a 7%. Similarly, Bank B has already analyzed Company B, the risk profile of Company B. So Bank B, what does it says is that, okay, if I want to give you a loan, I will offer you a fixed coupon loan at the rate of 10%. Or in case you want to go a in case you want to go a floating rate of interest, then I will offer you MIBOR plus 1%. Okay. In floating wise, I will offer you MIBOR plus 1% because there is a higher risk of I giving you these amounts. So I can offer you MIBOR plus 1%. Now, students, you see, we have already known what are the different preferences of company A and company B. Company B prefers fixed, company A prefers floating. If company A prefers floating, company A can go ahead and take their deal at MIBOR. And if company B preferred fixed, company B can go ahead and take the loan from bank B at fixed coupon of 10%. However, since we are dealing about the interest rate risk management, there is an opportunity here. Okay. There is a clear cut opportunity here for company A, company B, and a third bank called Swap Bank. So what happens? Both of these companies approaches a third bank called as Swap Bank. Now, what is the role of Swap Bank? Both of them tell them their preferences. Both of them tell the quotes of Bank A and Bank B to them, fixed and floating. Now, Swap Bank has that information about Company A and Company B. Now, what will happen? Swap Bank will make two combinations. Okay. What it will say, option one, okay, option one seems to be the option wherein for A, Company A, it borrows in fixed and Company B borrows in floating for Company B. Okay. Then what is going to be the rate of interest? 7% collectively for both Company A and Company B put together. The rate of interest will be going to be 7%, which is fixed for A, and floating for B is MIBOR plus 1%. Clear, students, till now? This is the first combination. So in a way, for option one, can we say that it is MIBOR plus 8%? Correct? At a collective level. Similarly, for option two will be, let's say, vice versa, floating for A and fixed for B. This gives how much? Floating for A is exactly MIBOR plus fixed for B is 10%. So if you see option 2 will give them MIBOR plus 10% in totality. Correct? This is the interest rate that will appear in totality for option 2. Agreed? Now, students, see what Swap Bank will think. Swap Bank is saying that I understand company A that your preference is to borrow on a floating basis, but what you do, you borrow on fixed basis. I will make your fixed loan to borrow to floating basis. Similarly, it also says to the company B that I understand that your preference is to borrow in fixed basis, but you borrow at floating basis. Because Swap Bank says that option 1 is more feasible because in option 1 there is a reduction of 2%, M plus 8, M plus 10. At an overall level, there is a reduction of 2%. So what Swap Bank is saying, all of us can benefit with that 2%. It's just that for A, you borrow in fixed, for B, you borrow in floating. Rest I will manage how to do. Okay, now if you see, company A is instructed by the Swap Bank to take a loan from bank A, correct? So this is a loan taken and company A will pay to the Swap Bank at the rate of 7%, students. Because company A will borrow in fixed, right? Because that is what the better option is, company A to borrow in fixed. And similarly, Swap Bank will instruct company B to borrow in floating. So company B, and this is company, so sorry, bank B to company B. Now here also the loan is taken and company B will pay to the bank B at the rate of floating, which is MIBOR plus 1%. Correct? MIBOR plus 1% will be paid. Now, what this Swap Bank says that since company A has a preference of paying, since company A has a preference of paying the interest at a floating basis, so let's do one thing, company A, you swap your fixed interest rate liability with the floating interest rate liability, whereby Swap Bank will pay company A some fixed amount and company A will pay to Swap Bank MIBOR. Here Swap Bank will pay to company A, let's say 7.75 percentage. Okay. So what is happening? Company A, if you see, first of all, it is paying to bank A fixed 7%. Then company A is receiving 7.75% from the Swap Bank. And company A is paying to Swap Bank MIBOR. So ultimately, MIBOR plus 7% minus 7.75% is what the effective interest rate for company A is. Correct? We will come to that. The exact calculation. Okay. Now, from the company's B's perspective, since company B did not preferred to borrow in floating, but they end up borrowing in floating. So Swap Bank says that I will do one thing. I will pay you MIBOR. So what happens? I pay you MIBOR, whatever that MIBOR is. Let's say today MIBOR is 7%. Tomorrow it will be 8%. Then 1 month from now it can be 10%. Then it can be 7% back. So whatever it be, I will pay you exactly MIBOR. Using that, you pay your loan liability, which is MIBOR plus 1%. And in place of MIBOR, you pay me 8.25 percentage. So ultimately, Swap Bank had asked company B to pay fixed, and Swap Bank will pay company B floating. And Swap Bank will recover that floating amount from company A. Correct? If you see the cycle. Okay. Ultimately, Swap Bank will be left with 0.5% because Swap Bank is receiving 8.25. Swap Bank is paying 7.75. So Swap Bank is paying 0.5% less. So that is its commission. So this is commission of Swap Bank to arrange for this swap. Because here the Swap Bank is receiving Myro, paying Myro. Sorry, MIBOR and paying MIBOR. Simple. Okay. Now, so this 0.5% is the commission for Swap Bank. Understood, students, till now? Please let me know, then I will move ahead. Now, some of you will be thinking how this 7.75 has arrived, how this 8.25 has arrived, why there is a 0.5 percentage that I have kept. I will tell you. I will now take you through the calculations how this swap has been designed by the swap bank. Okay, first of all, we just wanted to understand the basic what is meant by swap. By swap, we mean that we are exchanging our fixed liability with a floating liability or a floating liability with a fixed liability. For company A, the fixed liability gets swapped with the floating liability. For company B, the floating liability gets replaced with the fixed liability. I hope it is clear, students. Please let me know till now. Now let's talk about a situation after swap. Students, I hope it is clear. Okay, thank you, Viraj. Shruti. So, what I'm saying is, after swap, how will the effective rate of interest looks like? Company A. Let's talk about company A first. So, company A is paying what? Is paying MIBOR, right? Is paying this 7% interest to bank A and receiving 7.75 from swap bank. Okay. Now, if we see company A's equation will be MIBOR is there plus 7% is there minus 7.75% is the recovery. So it effectively becomes MIBOR minus 0.75 percentage. This is the effective interest rate for company A. For company B, company B is first of all paying MIBOR plus 1% to bank B. Then it is receiving MIBOR from swap bank and it is paying 8.25 to swap bank. So can we write it as MIBOR plus 1% being paid to the bank? Sorry. Plus 8.25 percentage being paid to the swap bank minus MIBOR received from the swap bank. So this and this getting cancelled. So effectively it becomes 9.25 percentage for company B. Now, students, if you see from companies A's perspective, the companies A final effective rate of interest has been a floating rate because it has MIBOR in it, right? And companies B is actually 9.25, which is fixed. That is what they need. Company A wanted what? Company A wanted a floating rate. Company B wanted a fixed rate. Correct? So they have achieved the final objective. Now, if you add these two students, how much you get? MIBOR minus, okay, let me put total collective interest payout. Total collective interest payout is actually MIBOR minus 0.75% plus 9.25%. So if we solve this, it becomes MIBOR plus 9.25 minus 0.75. MIBOR plus 8.5 percentage, correct? It becomes this much. Okay. Now, if you see with our previous understanding in option one, it has to be MIBOR plus 8%. How come now the collective interest being paid by both the companies is coming out to be M plus 8.5? Come on, students, tell me. We devised our swap initially saying that the total collective interest payout will be MIBOR plus 8%. Now, after we have devised the swap, the total cost is coming out to be MIBOR plus 8.5. Then where is this 0.5 going, students? Tell me. Very good, Prashant and Shailesh. Both of you are right. It's going as a commission minus 0.5%. Then it becomes the original rate that we have contracted for. Yes, Satish, you are right. Kirti, you are also right. Commission. Very good, students. I hope you understood what essentially the swap bank had asked these two companies to do. Swap bank has actually asked them to collect MIBOR plus 8.5. Their arrangement was in totality MIBOR plus 8% and zero point 0.5 it will keep its own commission. Okay. Understood, students? I hope this is clear. Now, let's compare the before swap and so swap and no swap borrowing cost. So had we done no swap and here we have done swap. So there is a savings. Let's talk about company A first. So had company A done no swap, the company A would have borrowed in the floating rate of interest. So they would have ended up paying MIBOR rate, correct? They would have ended up paying MIBOR rate under swap. What is their final outcome? MIBOR minus 0.75. So don't you think after they have done swap, they are getting a benefit of 0.75, students? Because had they not done swap, then they would have ended up paying exactly MIBOR, which is the option given by bank A to company A, which is this. Correct? So effectively, there is a saving of 0.75% students for company A. Now, similarly, let's talk about company B. Company B, had they not done any swap, they would have borrowed at a fixed rate. The fixed rate quoted by Bank B to Company B was 10%. Since they have done swap, so in case of the swap, the final effective rate has come out to be 9.25 for them. So don't you think there is a saving of 0.75%? Okay. So 10% had the cost been if there is no swap? Since there is a swap, it has reduced to 9.25. Effectively, there is a saving of 0.75 students. And finally, swap bank. Had there been no swap, there is nothing. Since there is a swap, there is a 0.50 percentage income that the bank is enjoying. And hence the overall saving is 0.5% for the bank also, because in no swap, swap bank was not earning anything. So 0.5 plus 0.5 plus zero point 0.5 is actually 1.5 plus zero point 0.5 is actually 2%. Correct? So the total is 2%. And what is this 2%, students? Option, actually, if you see, this was option 2, right? And this was option 1 in the options that we had created earlier, right? So option 2 was this, and option 1 was this, correct? So swap was basis option 1, wherein the rate was M plus 8%. Here the rate was M plus 10%. So there is a difference between both of them of 2%, which is finally getting reconciled here. Okay. So this 2% difference between M plus 10% and M plus 8% is getting reconciled by 0.75 income for company A. Company B is also 0.75 and swap bank is 0.5. Prashant is asking, sir, bank will not demand MIBOR plus 1% from bank A as the company B is required to pay MIBOR plus 1%. No, Prashant. See, ultimately, if they ask from company A to pay MIBOR plus 1%, then this saving of 0.75 would have not flown to company A. And let me tell you one thing, the overall reduction in the interest cost is happening because of company A. Okay, why? Because company A's rate of interest are lesser than company B's. Even if you see fixed coupon, there is a 3% saving. Even in case of floating, there is a 1% saving. So essentially, if swap bank is not asking company A to pay MIBOR plus 1%, that means swap bank is telling company A that 1% you keep. Okay, students. Okay, Prashant. So it is not exactly, so swap bank will not match the exact cash flows of one company to another company. It will just see the entire maths, and basis the allocation of this gain or loss, it will do the calculations accordingly, students. Okay, students, let's come to question number 6. So, okay, before going to question number 6, in a nutshell, what is the swap doing? Swap is actually converting your fixed liability into a floating liability, or your floating rate liability into a fixed rate liability. Okay. Yes, Satish. Okay. Satish is saying, how is 8.25 to swap bank arrived? So, Satish, what bank swap bank would have done? Swap bank would have first of all seen that what is the, now if you see, we will just remove the, I mean, we will just reverse the mode of calculation to arrive at 8.25. Okay. See, what swap bank would have done is, first of all, it would have seen that what is the overall saving. It is 2%, correct? Now this 2%, it would have allocated between 2 and its own commission. Its own commission, let's say the bank has decided I will keep 0.5. That means out of 2, 0.5 is kept by bank, balance is 1.5. Balance 1.5 is divided equally between both of them. Now, basis 0.75, what should be the revised amount that has to be paid by company B to swap bank? Then, since bank already knew that since swap bank already knew that company B will pay M plus 1 to bank B and swap bank will pay to company B MIBOR, which is again M plus 1 minus M. So effectively, company B is already paying 1% extra. How much extra company B should pay to swap bank to arrive at this 9 point? How much? 25. Correct, because bank would have seen that 10% is what it will have. So if I reduce 0.75, it will be 9.25. So you see, step by step, we are going reverse. Similarly, bank would have gone reverse. So in practical life, how can a company approach bank? Guram is asking that. Good question. So if you see in practical life, we will not know that to a swap bank, let's say we are from company A, okay? We approach a swap bank, we will not know whether swap bank is having company B kind of a company also in the back end. Okay. So we will go to the swap bank and swap bank will do basis its own capacity or basis its own assessment that whether we are liable to be given a fixed converted into floating or floating converted into fixed. Okay. So in practical life, we always see one leg of the transaction. The second leg of the transaction that swap bank is doing internally behind. Okay. Okay, Guram. I hope this is clear, students. And practically, if you see, there are a lot of products that are available that convert your fixed rate liability into a floating rate liability or vice versa. Because generally people will convert their floating rate liability into a fixed rate liability that is more preferred, students. Okay. Now let's come to question number 6. Consider the derivative bank entered into a swap arrangement on a principal of rupees 10 crores and agreed to receive MIBOR overnight floating rate for a fixed payment on the principal. So this is a derivative bank. What is the swap designed for? It will receive MIBOR and it will pay fixed, right? So it is converting. It is converting floating to fixed, correct? Because it is receiving floating, that means derivative bank had a liability to pay in floating in the back end, right? That's why it is receiving floating and paying fixed. So that means it is converting its floating liability to fixed. The swap was entered into on Monday 19th August 2019 and was to commence on 20th August 2019. So they have agreed for this commitment on 19th August, effective from 20th of August and run for a period of 7 days, students. The respective MIBOR rates for Tuesday to Monday were 1, 2, 3, 4, 5, 6. Students, they have given us for the 6 days because in the notes they have mentioned Sunday is a holiday. Okay, so effectively for 6 days we have been notified. This is for Monday, right? And this is for Saturday. So Sunday is missing in between, which is the case has to be. Okay. Okay. So the Saturday rate is given and the Monday rate is given. Now they are also saying if fixed rate of interest is 8%, then evaluate the nature of this swap arrangement, the net settlement amounts. Work in rounded rupees and avoid decimal working. Consider 365 days in a year. Okay. Now, first of all, they're asking us to evaluate the nature of this swap arrangement. So this swap, as I mentioned, is to convert the floating rate liability into a fixed rate liability. So we can mention that the given swap is plain vanilla overnight index swap. OIS, we call it as overnight index swap. I'll tell you what this term means. Okay, Guram is saying, where is the swap bank? We only know bank. Yes, Guram. Even with swap bank, I only meant to say bank. In my entire case study, I have differentiated between bank A, bank B, and swap bank. Now, all these three banks could be a normal bank in the normal course, right? It's a normal bank. I just wanted to differentiate. That's why I have given different names. Okay. So now the given swap is a plain vanilla overnight index swap. Now students, hear me out carefully. What is OIS? OIS is a very important index for any economy. What happens, as I said that MIBOR is there, right? But there is not only a single MIBOR, there are different MIBORs depending on the maturity. So there will be a 6 months MIBOR. There is a 3 months MIBOR. There is a 12 months MIBOR. There is a, let's say, 9 months MIBOR. So students, why there is a 6 month MIBOR, why there is a 3 month MIBOR, why there is a 12 month MIBOR? The reason being, for different maturities, there will be different rates. Okay, for 12 month MIBOR, let's say the rate is appearing to be 9%. For 6 month MIBOR, let's say it is 7%. Similarly, for 9 months, let's say it is 8%. 3 months, let's say it is 6%, because it's a general understanding that higher the maturity, higher the interest rate. Yes, if I want to borrow for 12 months, I will be taken up for 9% per annum. If I take only for 1 day, or we also call it as overnight. Overnight means today I'm borrowing, tomorrow I will return. It is very less, 4% per annum. Now, students, can any one of you tell me why 1 day rate on a per annum basis again is the lowest? Why? And if you think through from my yesterday's session, you will be able to make it out. Just think of one reason why 1 day rate will be lesser compared to the higher maturity rates. Or the point what I'm trying to say is that maturity is higher, interest will also be higher. What is the fundamental reason for this? Why 1 day rate is always the lowest, students? And this you have to think through, wherein I mentioned that why are we paying interest? I mentioned there are two reasons. Okay, I'm giving you a hint. There are two reasons. Tell me, students, why 1 day rate is the lowest? Shailesh is saying inflation. No, still Shailesh, I'm saying that I've given you a per annum rate here. Okay, so inflation cannot be, right? Because I'm saying if you borrow for 1 day, I will apply 4% per annum. So that means effectively 4% into 1 by 365. That is for 1 day interest. Okay. Viraj is saying, I have got one answer, which is Kirti and Satish. Both of you are correct. Absolutely correct. Kirti and Satish. Guram and Shailesh, inflation cannot be the reason because I have given you a per annum rate. Okay. Had I given you, let's say 1 day rate and 6 month rate, right? Not on a per annum basis, but on an actual duration basis, then you could have told me inflation is the right reason. Yes, Gurram, now you're correct. Shalesh, yes, you are correct. Shruti, no, it's not time value of money. So Kirti, Satish, Gurram, and Shalesh, all four of you are correct. Very nice. What happens, students? If I tell you, just think it from a normal commercial perspective. If I tell you today that I want to borrow 500 rupees and I will return you by tomorrow. So if I'm a running company, now think about I'm a running company. Of my assets and liabilities change very significantly from today to tomorrow? Or will there be a very significant dent in my paying capability from today to tomorrow? No, right? The chances are very less. The chances are very less that my capability will get hampered of the repayment from today to tomorrow. So, in a way, one day or let's say overnight rate that has been quoted is almost risk free. It has no risk element involved. As I told you yesterday, interest is paid off because of two reasons. One is risk and one is time value of money. Now, if I say you that for one day I have to borrow, essentially one day there is no risk. Hence, for one day, which is an overnight amount, this 4% per annum indicates a riskless interest rate. There is no risk, students. Now, what I'm trying to say is higher the maturity, higher the risk. If you tell me that I want to borrow for 12 months compared to one day, so 12 months you will say, okay, 12 months, it might be possible that after 6 months down the line, some operationally you suffer a big losses and hence you are not able to repay me back. So I will not give you for 12 months at the rate I will give you for one day. Okay, make sense? So overnight rate is denoted by, as I told you that these are all the MIBORs, right? MIBOR 6 month, MIBOR 3 month, MIBOR 12 month. You will see in the question, in one of the question, it was mentioned that the company agreed to receive MIBOR 6 month rate. That means they're talking about this. Although it will be per annum, students, the quotation will be per annum, but 6 months means if you borrow for 6 months, then we will apply 7% per annum. Similarly, for one day, it is called as overnight index. So this rate also keeps on changing on a daily basis, right? Now, because time value of money will also change this rate, correct? So overnight rate also keeps on changing on a daily basis. That is called as overnight index. And if I swap that overnight amount with a fixed interest, it is called as overnight index swap. Okay. I hope it is clear. Overnight index swap is what? Overnight index swap, we are swapping overnight rate with fixed rate. So we are swapping overnight rate with fixed rate. And let me tell you, students, this OIS, this is not from the topic. I'm just telling you from a interest point of view. If overnight index swap, or let's say, sorry, overnight index rate, I'm not talking about swap. Swap, we understood, right? If I'm swapping overnight rate with fixed rate, that is called as overnight index swap. So if overnight index rate in any economy becomes higher than the higher maturity rates, see, this is the regular situation of a economy, right? And if there is an inverse situation that happens, wherein let's say overnight becomes 10% and 12 months becomes 8%. Okay. So higher maturity becomes lower. It is called as a inverse yield curve. It is called as an inverse yield curve, and it is an indication that the economy will get into a recession, which has happened for US in 2008. At that point of time, just before the recession hit there, the yield curve became inverse, wherein the OIS, the overnight rate was higher and the higher maturity rate was lower, students. Okay. This is just an additional piece of information, nothing to do with our curriculum. Okay. Now, coming back, I hope the question is clear. With this, the discussion of overnight index is also clear. Okay. Now, let's come to the solution part. So, the first part we have already told, this is a plain vanilla overnight index swap. So, plain vanilla means which has no added features. It's a very basic swap. Vanilla means very basic. It has no added features. Okay. That is called as plain vanilla. Now, the second part, they have also asked us to calculate the net settlement amounts. So let's calculate the net settlement amounts. Calculation of net settlement amounts. Okay. These are the days. So we will start with Tuesday. Then we will go to Wednesday, Thursday, Friday. Then Saturday and Sunday will be joint. Then Monday. Why there are 2 days joint? Because Sunday there is a holiday. So whatever happens for Saturday, the same thing will happen for Sunday. What is the principal? Principal amount is 10 crores. Correct? 10 crores. MIBOR. Overnight MIBOR was how much on Tuesday? Let's start with the first rate. 8.15, students. And hence the interest amount will be how much? It is easy, right? 10 crores multiplied by 8.15 percentage multiplied by 1 by 365. Correct? Because for 1 day, this 8.15 percentage will get multiplied. So this becomes how much? I'm just again erasing this. I'll just write the exact numbers 22, 329. No, Kirti, recession is not a favorable situation. Will these OIS rate available in any platform just like trading does? Yes, Prashant. You just type on Google and check what is the overnight rate appearing even for the Indian economy. For different markets, it will be different. Okay. It is there, Prashant. Because I'll tell you, in the bank side, the borrowing and lending happens for 1 day also, right? Because they have a big position. So what they do, they keep on rolling that position using 1 day borrowing or investing rate. Okay. Then let's come to the Wednesday's principal amount. So now, students, what happens? Since this is a 1 day amount, the 1 day amount will get credited and it will increase your principal. So the Wednesday's opening will become 10 crore 22,329. Now on this amount, the next day's 1 day MIBOR will be taken, which is 7.98 percentage. So this will become 21,868. Then this will get added to the principal to arrive at the Thursday's opening. So Thursday's opening will become 10 crore 44,197. Okay. And the interest rate applied will be 7.95%. So this will become 21,790, students. Okay. Then the next part is 10 crore 65,987. Again, the interest will be applied on this number, the revised principal, at the rate of 8.12. Sorry. And the amount becomes 22,261. Now for Saturday and Sunday, what will happen? It will get added again 10 crores, 88,248. Here the interest rate of 8.15 will be applied for 2 days, students. Okay. So essentially we will do 2 by 365. In all the above calculations, we were doing for one day, 1 by 365. Here we will do for 2 by 365. Okay. So it becomes 44,697. And last for the Monday, it becomes 10 crore, 1 lakh, 32,945. And it becomes 7.75. Okay. Percentage. So this becomes 21,261. So this becomes 21,261. The total is 154,206. This is the total, right? That has to be paid, right? So what is the question? Yes, so this has to be received, sorry. 10 crores and agreed to receive MIBOR overnight floating rate for a fixed payment amount to be received. Now, we will have to also calculate the fixed amount to be paid. This will be 10 crores into 7%. Sorry, fixed was 8%, no? Not 7%, it is 8%, yes. Into 8% for 7 days put together. Okay, so this becomes 8% into 7 divided by 365. 153,425. So net amount to be received is 781. Yes. Okay, students. So this is the answer for second part of the question. For first part, Guram, I will show you. We have already mentioned it's just a one-line answer, Guram. I will just show you once. All of you copy this. So for the first part, this was the answer, the first line only till here. In this box, the answer is there. Rest all I've just put to explain you what is OIS. Okay, it's not part of the answer. It's just to explain you what is OIS. Okay, let's go ahead, students. Question number 7, students. A Inc. and B Inc. intend to borrow $2 lakh and $2 lakh in yen respectively for a time horizon of 1 year. So it's a question of two companies, students. There is a A Inc., there is a B Inc. A Inc. wants to borrow $2 lakhs. B Inc. wants to borrow $2 lakhs, but not in dollar terms. It wants to borrow in yen terms. The prevalent interest rates are as follows. They have given us for company A and company B both. If they borrow in yen, what is the interest rate? If they borrow in dollars, what is the interest rate? They have given us. The prevalent exchange rate is $1 is equal to yen 120. They entered in a currency swap under which it is agreed that B Inc. will pay A Inc. at the rate 1% over the yen loan interest rate, which the letter means A here, right? Because A is put in letter. So which A will have to pay as a result of the agreed currency swap, whereas A Inc. will reimburse interest to B Inc. only to the extent of 9%. Now see students, this is A Inc., this is B Inc. So A Inc. will pay to B Inc. interest to the extent of 9% and B Inc. will pay to A Inc. 1% over the yen loan interest that A is paying. Okay, simple, clear. This is the swap. Keeping the exchange rate invariant. That means they are saying exchange rate you keep as same from current year to the next year because the borrowing is for 1 year. Quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So students, first of all, we have to identify what is the designed currency swap. The question has been very beautifully drafted in such a way that it has not told you that what is the currency swap that they're talking about, students. Can we find out basis the approach that we discussed in our example that we were discussing? Yes, let's try. So there are two options again. There are two options for designing the swap. Let's evaluate both of them. Option 1. So A borrows in dollars and B borrows in yen. Then what is our interest rate? A dollar is 9%, B yen is 8%, 9 plus 8. 17% students. Let's think about option 2. A borrows, A borrows in yen terms. B borrows in dollar terms. So this is 5% plus 10% is equal to 15%. So can we say that option 2 at an overall level is leading to a better interest cost, right? Because option 2 has a lower amount. So we can say option 2 is leading to the most optimum borrowing cost, and hence the same should be used as designed currency swap. Okay. And as a result, okay, before we go there, so students, even this swap, the option that we have picked, that A should borrow in yen and B should borrow in dollars. First of all, is it a preferred mode of borrowing for A and B? No, because A's preference is to borrow in dollars and B's preference is to borrow in yen. See, correct? Respectively. Respectively means A wants to borrow in dollars, B wants to borrow 2 lakh equivalent dollars in yen. Okay, agreed? So, first of all, their preferences are A to dollars and B to yen. However, the option that we have finalized is A in yen and B in dollars. That is why there will be a need of swap. Further, it is also mentioned in the question and indicated that B Inc. will pay to A at the rate 1% over the yen loan interest rate, which the latter means which A as a result of the agreed currency swap. That means the question also is indicating that A will pay yen loan interest rate, and over and above that 1% will be paid by B to A as a result of swap. So that means A needs to borrow at first place in yen as per the swap, right? So which again signifies that option 2 is the right option that we have selected. Students, am I clear till now? Now, as a result, following swap payments are agreed. Okay. What are they? A would pay to B. How much? That is given as 9%. B would pay to A. How much? What is A supposed to pay on yen loan? 5%. B is supposed to pay 1% over and above 5%. So B will pay 1% plus 5% is equal to 6%, students. Okay. Now let's talk about this swap. So A will end up in borrowing yen, correct? And pay how much? 5%. A will pay to the swap bank 9%, which swap bank will pay to B as 9%. And B will pay to dollars borrowing at the rate of 10%, correct? So ultimately A is paying to B 9%, that we know. And here B will pay to A at the rate of 6%. Similarly, which will be passed on to here by swap bank to A. So in this case, students, swap bank is not having any commission. Okay. Not to get surprised, because let's say the swap bank would be the same. that company A is company and company B is also dealing with. Okay. So they would be earning their commission basis the regular interests. Okay. So ultimately, what is the overall cost for A? A will pay 5%. It will also pay 9%. It will receive 6%. So 5 plus 9, 14 minus 6 is 8%, correct? Similarly, for B, B will pay 10% for the original borrowing, plus will pay 6%, minus will receive 9%. 10 plus 6, 16 minus 9, 7. So 8 effective cost for A, 7 effective cost for B comes out to 15%, which is our option 2 cost. Okay. I hope students the swap is clear. Yes. I hope the swap is clear, students. Okay, Viraj and Shailesh, thank you. Kirti, design currency swap. Kirti, see, the question has not given you very clearly what is the currency swap design. So this is the design currency swap that we have done. That A Inc. will borrow in yen and B Inc. will borrow in dollars. Then they will swap basis what is given in the question, their interest payments amount. A will pay to B fixed 9%. B will pay to A 1% over and above what A is paying for yen loan, which is 6%. So 5 plus 1, 6%. Okay. Perfect. Viraj and Shruti. Very good. Now let us compute the gain or loss because the question has asked us to indicate quantify the opportunity gain or loss component of the ultimate outcome resulting from the swap. So let us start, students, for the calculation, please. So opportunity gain slash loss for A Inc. Let's discuss first. And this we are calculating in dollars. Okay. This we are calculating in dollars. First of all, interest to be remitted to B Inc. under the swap, right? So on 2 lakh dollars, 9% for 1 year. So in dollar terms, it becomes $18,000. Correct? 9% is what A will pay to B. Second, interest to be paid to bank for yen borrowings. Okay. Now, the company A would have borrowed from the bank in yen, right? So what is the exchange rate, students? Exchange rate was 120 for $1. Yes. So for 2 lakh dollars, the company would have obtained a loan of 2 lakh into 120. That is how much? 240 lakhs, right? That means 2 crore 40 lakhs yen, right? Multiplied by what is the interest rate? 5%. Okay. But since we are doing calculation in USD, so we will again convert this into USD. The interest payment needs to be converted into USD. So this becomes 10,000. So 18,000 into 10,000. interest to be received from B. 2 lakh is the USD amount. On that, B will pay to A how much? 6% for 1 year. So $12,000 bank will receive, company will receive. So this becomes 10 plus 18 is 28 minus 12 is $16,000. So this is the interest cost under swap is $16,000. And how you calculate opportunity gain or loss, students? Opportunity gain or loss is under swap, what is the cost minus without swap, what had been the cost. So can we say that interest cost without swap 2 lakhs into what would have been the percentage? 9% for 1 year. Correct. Had this swap not been there, company A would have borrowed in the USD rate. Correct. What is the USD rate? 9% for company A. So they would have ended up incurring $18,000. So there is an opportunity gain of $2,000. Clear, students? Let's come to the calculation of opportunity gain slash loss for B in yen. Let's do this calculation in yen because the preferred currency for B is in yen. So in yen, first of all, B to pay interest to A Inc. How much it is? Loan amount will be again 2 crore 40 lakhs multiplied by what is the swap percentage agreed? 6% for 1 year. So this becomes 14 lakh 40,000 yens. Second, B Inc. to pay interest to bank. This will be how much? 2 lakh dollars into 10%. 10% is the rate that B will borrow a dollar loan, right? So 2 lakh dollars B Inc. has borrowed at 10%, and to calculate it in yen, multiplying it by 120, correct? Again for 1 year. So this becomes 24 lakhs. Third, B Inc. to receive interest from A Inc. So B to receive interest from A is 9% students, right? So 2 crore 40 lakhs into 9% for 1 year. So this becomes 21 lakh 60,000. So this net becomes 16 lakh 80,000 students. Net interest cost under swap, which is 16 lakh 80,000. Interest cost without swap would be how much? Now, being would have borrowed in yen. The yen rate for being is 8% on 2 crore 40,000 yen. It had been 19 lakh 20,000 on account of swap is 2 lakh 40,000, which in dollar terms is also $2,000 students, equivalent to $2,000. Clear, students? I hope. Okay, Gurram is saying, please re-explain once. I will do that. So if you see, the question is very simple, students, first of all. Why? Because, so there are three legs for both A and B. What are those three legs if they enter into a swap? One is to pay to the bank for the original borrowings. Second is to pay to the other party. And third is to receive from the other party, right? Now, if you think about from A's perspective, as per the designed currency swap that we mentioned, the option that came out for A to borrow is in yen and for B to borrow in dollars, although they had a reverse choice for their preferred borrowing. But we still told them you borrow in these aspects so that your overall savings will be significant, which is around 2%. So that we have distributed in the form of the swap that has given by the question, that is 1% over and above what A will pay and 9% what A will pay to B. Okay. Now, if you see, this is the main chart. Gurram and everyone who just wanted to have a proper view, this is the very proper chart. Okay. In this, we have mentioned that A will pay to yen borrowing at the rate of 5%. A will receive 6% and A will pay 9%. Now, since the preferred borrowing currency for A is given as dollars, so we have done all the calculation in dollars for A, assuming that A's functional currency is dollar. Similarly, for B, since the preferred borrowing was in yen, the interest rate being same and the exchange rate also being same from 0 year and first year end, we have done all the calculations in yen. And for being similarly, 10% is what it is paying for a dollar rate. 9% is it is what receiving from A Inc. under the swap. And 6% it will end up paying to A Inc., which is the 5% plus 1% that is mentioned in the question. Okay. One more thing, there is a twist in the question which says that you have to calculate the opportunity gain or loss. Now, how you calculate opportunity gain or loss? One, by telling that if you enter into this swap, what is your effective cost? And compare that with the cost had you not entered in that swap. So which is what we have done a comparison. So 16,000 is the net amount of the interest cost under swap. If we have not entered into the swap, we would have ended up paying 18,000. So that means because of this swap, there is a benefit of 2,000. Similarly, from Being's point of view, 16 like 80,000 yen would have been our net interest cost under swap. So interest cost without swap is 19 lakh 20,000. So in a nutshell, you are able to save 2 lakh 40,000 yen, which is nothing but $2,000 at the current exchange rate of 120. Okay, Gurram, I hope it is clear. Gurram Venkat Harshit Kumar, I hope this is clear. So in a nutshell, this question had two problems. One, to calculate the opportunity gain or loss, and second, to identify the right swap. Okay, both of them are clear, students. So, yes, Viraj and Guram, it's clear. Okay. Question number 8. A textile manufacturer has taken floating interest rate loan of rupees 40 lakhs on 1st April 2012. The rate of interest at the inception of loan is 8.5 percentage per annum. Interest is to be paid every year on 31st of March. And the duration of loan is 4 years, students. In the month of October 2012, the central bank of the country releases the following projections about the interest rates likely to prevail in future. Okay. Now, what are they? On 31st of March 2013, which is 6 months from now, because let's say we are standing on 1st of October 2012. On that date, central bank releases some of the information about the projections. So from 6 months from now, 31st March 2013, interest rate they're saying it going to be 8.75. Similarly, 1 year after that, which is 31st of March 2014, it is expected to move to 10%, right? 16. So clearly, as per this information, the interest rates are expected to go up. Show how this borrowing can hedge the risk arises. His interest cost at 8.5, but he wants to put a cap. Assume that the premium negotiated by both the parties is 0.75% to be paid on 1st October 2012. Now, the question is also suggesting premium. We are talking about which instrument? Is it forward rate agreement? Is it interest rate futures? Is it interest rate guarantee? Or it is swap? Tell me, students. Shailesh, please recheck. Others request to please answer. We are talking about premium here. We are talking about cap. Yes, Prashant, you're right. Premium comes in interest rate options, interest rate guarantee, which is a cap option. We're talking about cap option here, right? To be paid on 1st October and the actual rate of interest. No, it's not futures. Abdul, it's not futures. Shailesh, it's not future. We're not talking about future. We're talking about the options, interest rate guarantees, right? Because there is a two 11.5, 9.25 and 8.25 show how the settlement will be executed on the perspective interest due dates. So first of all, students, this question is saying that on 1st of April 2012, the textile manufacturer has borrowed 10.5%. Now let's take 31st March 13, 31st March 14, 31st March 15, 31st March 16. Okay, then 10%, 10.5% and 7.75%. So this is the central bank's quote. And somewhere here, 1st October 12, 0.75 percentage premium is required to be paid for entering into a interest rate cap, and how much actual turns out to be 10.2. Correct. 31st of March is 10.2%. Then 2014 is 11, and lastly it is okay. Calculate the executed on the prospective interest due dates. Now, if the textile manufacturer needs to interest payment March 2013, okay, hedged, has to be hedged, then this textile manufacturer will enter into a cap option. When will that cap option will give benefit to textile manufacturer will gain out of that? March 2013, the actual interest rate is 10.2, 10.5 to 58,000. This is going to be our cash inflow, students. So this will be received by textile manufacturer from options exercised. Okay. Students, is it clear? I hope, students, it is clear now. Okay, Viraj. Now I hope it is okay. Then for March 2014, what is the interest rate? 11.5. Again, the option is a in the money option because the strike rate is 8.5. Actually, the interest rate has gone up to 11.5. So there will be a gain of this differential percentage, correct? Which is 1,20,000, students. This is again received. This is a cash inflow. Textile manufacturer. Then March 15, students. March 15, what is the rate now? 9.25. Still, it is better than 8.5 because the strike rate is 8.5. The option will be in the money for 2015 as well. Okay, so this will be 0.75 in. So this will be 30,000 received by textile manufacturer. This 30,000 will be received by textile manufacturer, students. This is also cash inflow. For March 16, students, what is the rate of interest? 8.25. The rate is 8.5. So that means textile manufacturer will pay the difference of 8.5 minus 8.25. This will be a cash outflow. Come on, students, tell me, is it right thing that I mentioned? In case the interest rate becomes 8.25, the strike rate is 8.5. Does the textile manufacturer needs to pay any differential amount under cap option to the option seller? Tell me, should I put 0.25 into 40 lakhs, around 10,000? Is the cash outflow? Is it correct, students? Is it correct or not? Tell me, students, whether this person, the textile manufacturer, will be required to incur a cash outflow on account of low interest under this instrument. I'm waiting for your responses. Yes, Prashant, you're right. Prashant has given the response. Rest all also I request to please respond. In case the interest rate is lesser than 8.5, then will there is a need of cash outflow of this 10,000. Come on, students, tell me. Satish, you are also right. So, since this is a cap option, there is no need of this cash outflow, students. So, cap option itself gives right to the holder that in case it becomes higher than the strike rate, then only you exercise and get the money. Okay, so March 16, what will happen? Yes, Abdul, you're also right. Since this is an option, hence there is no need to exercise it. So March 16, the textile manufacturer will not exercise the option. Okay, the textile manufacturer will not exercise the option. What he or she will do? Take the open market rate. Or let's say the open market rate should be accepted by textile manufacturer. Okay, students. I hope this question is clear, students. Question number 8. The calculation and the logic is clear. So, students, what I just wanted to convey is that the questions on interest rate swap is giving you some indication. Now you have to identify through that indication that what is the right set of instrument, what is the problem first that the person is facing, where does the hedging lies, and what is the exact instrument. Once it is identified, then the question follows a very sequential step to solve them. Okay, let's move to question number 9. This is also a very good question, students. So there is a company called Drill Dip Inc., a US based company, has won a contract in India for drilling an oil field. So this is Drill Dip Inc.
progress.
It will require an initial investment of 500 crore. The oil field along with the equipments will be sold to the Indian government for 740 crores. So simple. Investment 500 crore. What I will get back is 740 crore in 1 year. Okay. So my cash outflow today is 500 crore. Cash inflow 1 year from now will be 740 crore. This is both in rupees terms. Since the Indian government will pay for the amount in rupees, the company is worried about the exposure due to the exchange rate volatility because drill dip has a functional currency of US dollars, which is based out of US. It has contracted 500 crore as a fixed cash outflow in INR terms and receiving of 740 crores as a fixed cash flow in the INR terms again. You are required to construct a swap that will help drill dip to reduce the exchange rate risk. Second is assuming that the Indian government offers a swap at a spot rate which is 1 US dollar is equal to 50 in 1 year, then should the company opt for this option or should it just do nothing? The spot rate after 1 year is expected to be US dollar 1 to 54. This is a forward rate actually. Forward rate for 1 year. Further, you may assume that the drill dip can also take a US dollar loan at 8% per annum. So what they are saying is that the cost of borrowing to this US company, which is drill dip, is 8% per annum. Okay. And today the exchange rate is $1 is to 50. And the swap is also available at $1 is equal to 50 for today and 1 year cash flows from today. Correct, because it is saying that the Indian government offers a swap at a spot rate which is US dollar 150 in 1 year. Okay. However, the forward rate of 1 year appearing as on today is $1 is equal to 54. So let's see what all our things are given. Swap available is $1 is equal to 50, 1 year times duration. Okay. Forward rate $1 is equal to 54. This is for again 1 year. Okay. Loan cost is 8% for drill dip. Okay. Now using this, can we devise a swap? Yes, we can devise a swap. What we can do is we can tell. So let's say we are representing drill dip US in India. So we can tell to the Indian government that we will swap basis the 50 rupees to $1 today for the 500 crore investment. Okay, see transactions. The swap it works is I will give you dollars, you give me INR. Then after 1 year, I will give you INR, you give me dollars back. You're getting my point? So this is how the swap works. Because today I'm swapping dollars with INR, and 1 year from now, I will swap INR with dollars. So A part can be entered by drill dip a US dollar loan today at an agreed rate with any party to obtain Indian rupees to make initial investments. Understood, students? So what it will do, it will swap the required USD amount to get 500 crore rupees in INR. And also, students, since in the entire, you know, entire financial management, we always think that whatever amount we have to invest today, we don't have. We have to take a borrowing of that. Sorry. So we will borrow that amount, give it for swapping purposes, get INR rupees, invest that INR rupees in the drilling project. What will happen 1 year from now? 1 year from now, we will swap back the INR rupees at $1 is equal to 50, correct? And we will get the US dollars. Using that, we will repay our loan. So the initial position in swap is clear. So today it will happen. And 1 year from now, what will happen? After 1 year, swap back the Indian rupees with US dollars at an agreed rate. So after 1 year, we will swap back the Indian rupees with the US dollar at an agreed rate. In such case, the company is exposed only on the profit earned from the project. Okay. So what will happen? If I today swap some amount, the same amount I will swap 1 year from now. The only thing is balance 240 crores, which I'm earning extra, that I will have to exchange it at the spot rate that would have been appearing after 1 year from now, which is the 54 US dollars, right? So 54 rupees to 1 US dollars. I think the swap is clear, students. 1 year means 1 year from now. I mean, after 1 year, since the drill dip will get back 740 crore rupees in INR, the swap happens as I told okay, let me put it here. Let's say this is a company. It will pay dollars, receive INR. Okay. Let's say it is paying dollars of 1 crore. It will receive INR of 50 crore. Correct? Because $1 is equal to 50. This is happening today. What will happen to the A company 1 year later? 1 year later, A company will get back 1 crore dollars and it will have to pay 50 crore INR. Clear, students? This is how a swap works in a foreign exchange transactions. Okay, the rate gets fixed. $1 is equal to 50 rupees gets fixed for today exchange as well as 1 year from now exchange. Okay, the same amount gets exchanged today and the same amount gets exchanged 1 year from now. Okay, Viraj is saying it is clear. Prashant, 1 year means is I hope it is clear now, right? Now let's come to the second part. Now they are asking us to construct. So construct a swap is done. Then should the company should opt for this option or should just do nothing? So we will have to compare two options. One, the company does not do anything. Or second is company opts for the option. I mean the swap. Okay. So let's say company opts for swap. This is the first part. Okay. under B first part. So what will happen? Year 0, year 1, okay, buy 500 crores at spot rate, or let's say swap rate, because spot rate and swap rate is same in this case. So in USD terms, let's do all the calculations in USD term, because this company is based out of US. It will think from the USD perspective. So minus $100. Let me put 100 million. Okay. $100 million will be paid to swap the 500 crore rupees. Okay. I will pay 100 million. I will get 500 crore, which I will invest. Then 1 year from now, what will happen? Swap 500 crores at the rate spot rate, or swap rate, which is same in this case, to get back the $100 million here as a positive inflow. Okay. I will also do one thing. After 1 year, I will sell the balance 240 crore at the rate $1 is equal to 54 rupees. Reason being, this was not covered under the swap. So how much I will get? 44.44 is what I will get, which is 240 crore divided by 54, correct? And converting into millions. So this will become 44.44 million students. Okay, so this is again my incremental cash flow. And I will end up paying borrowing cost at the rate of 8%. How much will it be? 100 into 8%? Minus 8. So this will become minus 100, and this will become 136.44. Correct? So year 0, net there is a cash outflow of minus 100. Year 1, there will be a net cash inflow of 136.44. Students, I am hoping it is clear. Okay. Then, so we have done the calculations that net result is receipt of US dollar 36.44 millions. Okay. Now B part, second sub part is without the swap. Let's say the company opts for no swap. Now in such a case, students, what will happen? The company will still buy 500 crores at the rate of spot rate, right? Okay, let me do one thing. Sorry, students. I will need to put it again 0 year and 1 year. This is year 0. This is year 1. $1 million, $1 million. Okay. So this is by 500 crore at the rate of $1 is equal to 50. Okay. The spot rate. So 100 million will still be an outflow in year zero. Now here simply it will sell 740 crores at the rate of $1 is equal to 54. So entire amount will get sold for 54 rupees. So it becomes 137.04 USD million. Okay. Also, it will have to pay interest at the rate of 8% on $100 million. So this becomes $8 million. So this becomes minus 100. This becomes 129, 129.04. So this is actually resulting into a net receipt of dollars 29.04 million students. Prashant is saying why we receive 100 after 1 year. Prashant, because this is what swap is doing. Swap is giving $100, $100 million today, and under this swap we will receive $100 million 1 year from now, which is this. Okay, this is the arrangement under swap. Had we not done any swap, then we will receive basis the existing exchange rate, whatever is operating at that point of time. So what is our decision, students? Decision is, since the net receipt is higher in swap option, the company should opt for the same. Clear, students? So this was a question on deciding whether the company wants to enter into the swap or not. And we have concluded that company should enter into the swap. Reason being, if the company takes on the swap, the company will, with whatever is the arrangement, vis-a-vis $29 million if the company does not enter into a swap arrangement. Yes, Satish. Very good, Satish. I really like that thought. Satish is saying, since the rupee value is decreasing, hence it is better to go with the arrangement of swap. Yes, that is absolutely what I was telling. So since the rupee value has decreased from 50 rupees to 54 for the same US dollar, imagine someone is investing in India. Now they want to take their investment back. While they have invested, they have got 50 rupees. Now, while they're taking back, they will be charged 54 rupees. So 4 rupees on 50, roughly 9.5% is what they have incurred a loss in the depreciation of the currency for 1 year. That is why this option of not entering into a swap and securing their rate of 50 is not beneficial. Okay. Very good, Satish. Question number 10, students. IM is an American firm having its subsidiary in Japan. Okay. So IM is an American firm having its subsidiary in Japan, and GI is a Japanese firm having its subsidiary in USA. They face following interest rates. For IM and JI, there are two different rates. USD floating rate is LIBOR plus 0.5, LIBOR plus 2.5 is for JI. JPY fixed rate is 4 and 4.25. So JPY is operating in a fixed rate basis, USD is operating in a floating rate basis. IM wishes to borrow USD at floating rate like this, and JY at a fixed rate. That means this. Okay. The amount required by both the companies is same at the current exchange rate. A financial institution requires 75 basis points as commission for arranging the swap. So here in this question, there comes commission. In the previous question, there was no commission. So here 75 basis points, which is 0.75 percentage, is needed as commission. The companies agrees to share the benefits loss equally. Now beyond that, whatever is the benefit or loss, they will arrange it equally. You are required to find out whether a beneficial swap can be arranged for. Yes, we can find it out. IM and JI, there are two companies. What is their preference? Preference is to borrow USD at floating rate. JI's preference is to borrow JY at fixed rate. Okay. So let's compare both. Option 1, wherein IM is borrowing in a dollar rate plus JI is borrowing in a JPY rate. So this happens how much? LIBOR plus 0.5% plus 4.25%. Okay, so this becomes how much? LIBOR plus 4.75% students. Option 2, IM borrows in JPY plus JI borrows in dollars. So how much will it be? Plus 2.5%. So this becomes LIBOR plus 6.5%. So what do we do, students? What do we do? The option 1 is more beneficial, right? Compared to this. So what is the difference, students? So if we see between option 1 and option 2, option 1 is quoting a rate of LIBOR plus 4.75%. Option 2 is quoting as LIBOR plus 6.5%. So the differential. Now, students, see, there was one question being asked, right? How have we arrived at the cash flow at the respective swap interest rates and the commission? Now, this question we will be able to answer that. Okay. Now, what is the differential, students? 1.75%. So that means there is a net savings of 1.75%. Correct? 6.5 minus 4.75. So 1.75 is what we are able to save. Differential savings. Now, out of this 1.75, the split will happen how? Financial intermediary, which is the swap bank equivalent, will get 0.75%. That is mentioned. Now, balance is how much? 1%. Out of 1.75, 0.75 you are giving to the financial intermediary, 1% is left. Now that 1% will be shared equally between both of them. Right? So, share of IM, share of JI. Okay, so this is the total savings. Okay, so this is how the distribution will happen between all of them. Simple, students. So option one is what will be preferred. That means IM will borrow at dollar basis and JI will borrow JPY fixed basis, and they will end up having 4.75. And the way distribution will happen is basis this table. What rate of interest for both IM and JI? They are asking us to say that what is the final rate of interest for both IM and JI. Let's calculate that, students. So since the savings of 1% to be shared equally amongst, what are the parties' name? IM and JI. The interest rates shall be so let's first calculate for IM, students. Okay. Borrowing from market will happen at what rate? LIBOR plus 0.5%. Correct? This is the original rate at which borrowings will happen from the market, less benefit from swap will happen at 0.5 percentage negative basis. So overall, it will happen as LIBOR. Net interest will become equal to the LIBOR for IM. Okay, so ultimately, IM is able to reduce from the original cost of LIBOR plus 0.5 percentage to LIBOR itself. Can we also calculate for JI? Borrowing from market. For GI, what is the borrowing rate from market? GI will borrow in JPY fixed, 4.25. Again, less benefit from swap. Benefit from swap is how much? 0.5%. So the net interest cost will be equal to 3.75%. So from 4.25, the original rate, the net interest cost will be arrived at 3.75 because of the swap, students. I hope this is clear, students. So for JI, the effective interest cost becomes 3.75, and for IM, it becomes at LIBOR. If they decide to borrow basis the option one, Perfect. Viraj is saying it is clear. Perfect. So students, this brings us towards the end of the interest rate risk management. Now, quickly, if we just want to, summarize and understand our overall understanding till now. So let me just take you through that quickly. So students, we started about the interest rate risk management from the very first underlying principle, which is interest as a percentage or interest as an element is never fixed. It keeps on changing. And it keeps on changing because of many reasons, primarily two of them for which interest is being paid is one, risk of non-payment, and second is the inflation or time value of money. Because of these, the interest rates has to be paid. Now we discuss that since the interest rates are bound to change because of some of the interventions done by the central government, that means through RBI, or because of the market forces. Hence, there is a need to do the hedging of such interest rate risk. Because today, if I have borrowed some amount at a floating rate and tomorrow the interest rate goes up, I am sitting at a P&L exposure. To avoid such P&L exposure, we have to hedge our interest rate risk. For that, we said that there are 5 techniques, 2 in traditional and 3 in modern. The 2 traditional techniques were ALM method, asset liability method, forward rate agreements, interest rate futures, interest rate guarantees, and swaps. So asset liability was very simple, where we said that we will match the maturity profile. Forward rate agreements, we said that we have to think it from the perspective that these forward rate agreements has to be entered not today. I mean, the forward rate agreement will be entered today, but the execution of that will happen some years, some months later on, right? And there was a specific notation also that we understood, FRA 1/4. How will it work? Similarly, we also had gone through what is the formula for calculating the payoffs for FRAs. Then how will we value the FRA? The valuation of FRA was totally dependent on the end. So for example, we are talking about FRA 3/6. So what is the 6 months interest rate? What is the 3 months interest rate? And the differential basis this equation will give us the FRA rate for 3/6. Okay. Then we have also discussed about the interest rate futures, where we said that we will use the bonds prices and the bonds futures for managing the interest rate futures, the risk of interest rate management through interest rate futures. And we said that we will use this inverse relationship, and hence we have to be careful. If we are hedging against the interest rate going up, we have to short sell the bonds futures. Okay, there was a question also that we did. Then interest rate guarantee is as good as the options, right? In derivatives that we studied about options, interest rate guarantee or interest rate options are very much similar to that cap option and floor option that we discussed. Then today we started swaps, where in detail we discussed about how swap works, right? And we did a lot of questions to understand the swap arrangements. Okay, students. Now I request C. Ashish sir to conclude. Yes, sir. Over to you. Hello.
Good morning, Devas.
Good morning, sir.
Is there any issue?
No, sir. There is no such
Okay,
pending
okay, okay.
queries.
Please continue. Please continue.
Yes, yes, sir. No,
Okay.
sir. We are done with the session actually.
Okay, okay. No problem.
The
So I am
questions.
continuing the session. Just have a pen. Okay.
Sure,
Just
sir. Sure,
a
sir.
second.
So students, if you have any queries till now, please let us know once. Because
Okay, students, just have some patience.
yes, sir. Yes. So okay, meanwhile, so what we discussed in interest rate swap was that there are two different companies. They approach swap bank and right. Essentially, after the floating to fixed and fixed to floating, we also discussed how currency swap works, students, right? In currency swaps, today, whatever the value is getting exchanged, right, the same rate will be used for the later on exchanges. Okay. So the last question that we did, the second last question that we did is reflective of the same fact. Okay. Then we said that in case of swap, it will help us in the benefits to both the companies as well as to the swap bank. Okay.
Devas, can I join the screen? If you are
Yes, sir.
okay, once you do it, just make the unlisted student, then I join you.
Sure, sir. Sure, sir. So I think that's all, students, from my end. I'm just, sir, disconnecting my screen.
Okay, okay. Is it visible now?
Yes, sir. Your screen is visible, sir.
Okay, students. Now, actually, you have gone through with the assignment. Now, there was one question has been left out that I thought I should discuss with you. Now, student, this question is from the earlier examination of CA final or scheme. Now, this is a question. A question is a combination of two options that is called collar. Okay. Now, in this question, see what happens. There are see if you read the question on that is on your screen. Just have 2 minutes and read it. Of course, we will add it in your assignment. Just have it reading, no the same plain reading. Just it says like that MPD Limited issues a 50 million floating rate loan on 1st July 2018 with a resetting coupon every 6 months equal to LIBOR plus 50 basis point. Okay, student, please note that LIBOR is no more there in the practice. So it is since it is a question of the earlier time. So it was at the time LIBOR was present. Now MPD is interested in interest rate collar strategy of selling a floor and buying a cap. So it means they are buying it is a kind of a call option and floor is a type of a put option. MPD buys the 3 years cap and sell 3-year floor as per the following detail on July 21st, 2018. Now the principal amount is 50 million. Okay, strike rate is 5 for the floor and 8% for cap. Nil because whatever be the you will pay for the cap, that will be you will receive for the floor because you are buying a cap and selling a floor. Reset date and the interest rates on the respective dates are given below. Okay, first reset date is 31st December 2018. On that rate will be 7%. Now similarly here, 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 and here, and here. Okay, now using the above data, you are required to determine the effective interest paid out of 6 reset dates, rounded of the nearest rupees, average overall effective rate of interest per annum. Now, student, in this question, now see, when we are buying a cap option, so cap option means call option, of course. So when we exercise our call option, if we are getting in a market price, then our strike rate. Here, the strike rate is our 8%. Okay, here for the floor 5%. Now we are selling a floor. Now, when we are selling a floor, it means the person to whom we are selling the floor, he will exercise his or she will exercise the option when the rate goes below the 5%. Okay. And we shall exercise our option when the rate goes above 8%. Okay. So this is the first part we have to understand. Accordingly, we have, we show here, one second. Now, what will be our cap receipt? Now, cap receipt will be our maximum of 0, comma, notional principal amount into LIBOR on the reset date minus strike rate. Okay, number 9%. Okay, then of course, this will be the 9 minus 8. However, if it is the rate less than 8, say I say it is 7%. So we say if it is our 7 and its strike rate is 8, so the figure will come negative. So we will not exercise our option. Okay, now we come to the floor payoff. Okay, now when we talk about floor payoff, here the maximum of 0, okay, minus floor strike rate minus LIBOR reset rate. You see here, it has been crossed like that. It has been somewhere crossed like that. So here, our option will be exercised. Our strike rate is basically 5%. So any rate below 5 will be used by the buyer of our option, that is floor. Okay. Now, if it will say it is a 4%, then of course he will exercise his option and we have to pay off. So first we have to understand this. Okay, student. So now we see how the statement moves like that. Now, student, this answer is a form in the I have presented. We have, this is from the your question answer, and it is in the form of your tabular form. Now, student, I just take back to you. What is basically my purpose is to include this question and make you one understand one thing. Here we are writing the number of days in the settlement period. Okay, now here it is very important because here we have to be very conscious about calculating number of days in the settlement period. Now let us see how we calculate the number first reset period number of days. Then we shall proceed further. Okay, let us see the solution. Now our first period is, see, we draw like table like that. First our reset date. Okay, then we use the LIBOR rate, then date of payment. Okay. Now our reset period will be 31st December 2018. Now here we have to see our LIBOR is basically on that date is 7%. So it means the period for which we shall pay will be from 1st January 2019 to 30th June 2019. And the number of days V121, I will show how you will calculate. And accordingly, this interest will be there. Now here, so first we do step by step, then I show you each item of the table. Now first I see on the reset days, first our part is how do we calculate the number of days. Okay, it is important for us. First we calculate number of days. Okay, the period will be applicable 1/1/2019 to 30th June 2019. Okay, student, now let me check whether we have received an query rating to save. Okay, I just continue. Now, first period will be January 2019. Okay, in January 2019, the days will be 31. Okay, now I take February 2019. The days are 28. March 2019. The days are 31. Okay, April 2019. The days are 30. This is May. The days are 2019. They must correct me if I am wrong on any place. Even student can do
Sure,
that.
sir. Sure, sir.
Hmm.
Sure, sir. Sure, sir.
Okay. Now the total number of days will be 181 days. Now student, here it is very important. This will be agreement for the future period, because if we are on any date, if the rate is known, so we don't buy or sell any option. It is mainly for the some future period. Accordingly, the reset, whenever what is reset, so that is always applied for the forthcoming period, not the retrospective period. It is very important to know. So accordingly, 181 days will be there. Similarly, if I talk about another reset date, that is 30th June, okay, the corresponding period will be July 2019. Okay. Now, similar way, if we carry out calculation that you can do at your own, I am just you do it yourself at your home. This days will be 184 days. Okay, now I am coming to next important point where generally mistakes can be committed by the student. That is for the reset period. Okay, student. Now here our period will be January 2020. Okay, the number of days will be 31. Okay, February, the days will be, now here point to be noted. The days will be 29 because 20 is a leap year. Am I correct?
Yes, sir. Yes, sir. Yes, sir. Absolutely. Absolutely.
Here in April, this figure comes 30th day, and in May, this days become 31, and June, the days become 2020. Accordingly, the number of days will be 182. Similarly, we can do it for the reset period. Thirtieth June 2020. It is July 2020. The days are 31. Okay, similarly, we go like that. The days come 184 days. Okay, student. Now let us see. This way, we shall calculate the days, applicable days. Okay. Now, next column is our interest payment. Okay, students, see, if we read the question, it says he has issued the 50 million floating rate bond on July 2000, resetting coupon every 6 months equal to LIBOR plus 50 basis point. It means LIBOR plus 0.5%. So this much of interest it has to pay anyway. Okay, it has to pay anyway. Whatever be the cap option or floor option, please always remember these are only meant for the notional principal. These are meant only for the notional basis. Their actual principle is not exchange. Only settlement is based on some notional amount. So that is very important word, notional. Accordingly, so he has to pay the anyhow on the interest that for the loan he has paid. He has borrowed the money, and so for this loan, the applicable rate of interest will be LIBOR plus on the reset date. So similarly, we shall calculate the interest for the each reset date. Okay, now let us start calculating the days interest payment for the each reset date. One second, student. There is a very good query from Suraj. So, as you said, sir, labor is not in use. So, how this can come in the examination? See, student, your question is very intelligent question, I will say, because you said that LIBOR is not in use, but so this kind of a question may come in examination, may not come in examination. No, student, please note that LIBOR is a kind of only benchmark rate. Okay, in the even though it has come into your examination, you have to attempt, assuming that whatever be the way. I'm just saying LIBOR has been discontinued. It does not mean it cannot be used. Anyone can use it, but practically it is not using it. Okay, practically we are not using it, but in examination you cannot say, sir, LIBOR is not in use, so we shall not use. That you cannot say. It is very important that you have to follow what is in the. It is a kind of a benchmark rate. Instead of that, it can be MIBOR. You just assume it as a MIBOR and answer that, but don't use word MIBOR. Okay, my request to you, whatever see, whatever facts given to you in the question, please follow the same. Okay, even LIBOR has been given. Continue to answer. Now I am coming to calculation of the interest part. Okay, now here the interest of that's our basis point 0.50%. Amount comes beta 11859 589. Okay, student. Now similarly, when we talk about next reset date, okay, the amount is same. Okay, the number of days is 184 days. Okay, the rate of interest is 8%. Similarly, now here you will have to have a catch. 50 million, no problem. Here number of days are 182 days, but in the denominator, please remember, in the denominator, as usual, we shall use 365, but here it is a catch. We shall use 366 days because it is a leap year. Okay, student? Most of the students commit mistake like here in this case. Okay, student. Now here 365, 366. Now next, if we take the 365. Last payment is 30th 21. Okay, student. Now we have completed our this part of table. Now let us see what shall be our cap receipt and what will be our floor payoff. Now if we see, in neither any rate is not exceeding our 8% strike rate. So of course there will be, we will not get anything from our cap option. So there will be no receipt on the can option part, cap option part. Now we rather we have to pay, and where we have to pay, here we have to pay because here it is a strike rate is, it is this LIBOR rate is less than our strike rate, and the difference will be 0.25% and 0.75%. Okay, student. Now let us see how we shall compute the payoff. Then our question will be near to completion. Okay, here again a catch. We have to take 366 days. So these payoff we have to make. Okay. Now ultimately the effective interest that we will pay, straightforward this amount, no problem. Straightforward this amount, no problem. Straightforward this amount. But however, here since we have are paying, so this amount will be added and equal. This will be our outflow. Similarly, here this amount will be added. It will be our outflow. This amount will be straightforward here. So overall total comes 98,13,703. Okay, student. So this is this amount we have paid during the our period, reset period, and this number of days in this reset period is 10,0196, because this is due to the leap year. This is due to the leap year. This figure may have come 1095. Okay, maybe this figure may come 1095. Add the leap year will not be there, but due to leap year there is a 1 day difference here. Okay, so now let us see how we calculate the effective interest. Thus, Overall, we have paid this much of amount for a sum of 50 million rupees. Okay, number of days was our 1096, and since we want it for the per year basis, so we are that's why we are using this factor. Okay, into 100. Our answer will be beta 6.54%. Okay, student. So I hope it must be clear to you when we use the cap option, how what benefits we are getting and how we can use for making our interest. So here we can say that somewhere its liability has been around 6.54%. The overall here on an average he has paid this much of amount. Okay, student. So with this, we come to the end to our lecture. And as a matter of practice, you can send your queries to your mobile app, or you can write us. You can contact me at this telephone number. Okay, you can contact us at this telephone. This is a BUS number. You can contact at this number. Now, student, whatever we have discussed in this classes of foreign exchange risk management and interest rate risk management. So these are normally part of the hedging part. These are the both topics are basically concerned with the hedging. And nowadays, since because it is we can sometimes it is also said that these are part of treasury management. Okay, so student, with this two important topics relating to your we can say hedging or we can say risk management topic has been covered. So with this, we come to the end of today's lecture. And Devas, sir, thanks a lot for sparing your precious time
Thank you,
and
sir.
enlightening the student on this topic. And student, thanks a lot for your patiently listening. We shall start our discussion on a new topic in our next class. Okay, students, have a nice day. And Devas, sir, have a nice day. Thank you very
Thank you,
much.
sir. Thank you, sir. Thank you. Thank you,
Yes.
sir. Same to you, sir. Thank you.
Okay. On the session over. Okay. Same to you, sir.
Okay, sir. Thank you.